Hey everybody, my name is Noah. Welcome to another episode of Systematic Investing, and today we're going to be talking about the Moody's U.S. debt downgrade from AAA to AA plus, and how what implications that has for the market and what we should do about it as investors. So, is it an impending crisis? Is it a nothing burger? I'm going to skip to the point really quick. As far in terms of like near-term volatility or anything, it's an absolute nothing burger. Who cares what Moody says? Like it doesn't matter. But uh, overall, the U.S. debt is obviously a huge problem. And here we'll go over a little history of the U.S. debt. Right here we got the chart. So as you see, we'll go over some key events here that kind of define the history of the U.S. debt. So first, we went off the gold standard, which allows like expansion of money supply, printing money. 2009, we had the Great Financial Crisis, which is the first time quantitative easing happened, and then we have the COVID pandemic, which obviously was a shit show, and we printed a ton of money. The government deficits ballooned completely out of control. Ever since then, we've been running one, two, three, $4 trillion deficits over and over. And right now, we're on a completely unsustainable path, and it's going to lead us to destroying the United States. So, like, what's going to be more important with this, rather than the actual debt number, is going to be debt to GDP. So, our debt to GDP ratio, as you can see, hasn't quite gone as vertical because, like I said, it's debt over GDP. So, when GDP grows, the number comes down. So, growth can offset this debt. So, as you see, great financial crisis, 2008, once again, that big gray bar just goes completely out of control and it goes 100%. COVID pandemic takes it to a different level of just absolute ridiculousness. So the only way to do anything about this is going to be shrinking the deficit. If we don't shrink the deficit, that debt will just continue to go parabolic. Debt to GDP will rise. When debt to GDP rises, it makes interest payments a giant percent of U.S. tax revenue, which is an immediate threat to our government as we know it. So the Trump administration has been talking big game about how they're getting the deficit way, way down, and they're making all these cuts with Doge, and they're saving all this money every day. So a lot of these so far the figures you see in the news will be like, oh, they're running up the numbers huge since last year, but those numbers are using the fiscal year from October 30, or sorry, October 1st to September 30th. So that includes Biden administration time and Trump administration time. So I said, screw it. I'm going to go on the St. Louis Fed website and I'm going to pull the deficit by month for the first 3 months and just see and compare it to last year, just to get a rough estimate. Because us as investors, I don't really care what the news says. I need to go and figure out what the actual data is because I'm using this to make monetary decisions that impact myself. So I'm not going to trust some random people to tell me what the data is. So I went and, like I said, this is very preliminary data. It's super early. 3 months isn't really a big data set, but so far, it rough estimate that the deficit has shrunk by 114 billion over 3 months. Like I said, very preliminary, but if you annualize this, will come out to 455 billion for calendar year 2025, not fiscal year, but calendar year. So based on that, they're doing all right, but I'd like to see way, way more than that. That's just the tip of the iceberg. So currently with a debt to GDP ratio of 122%, pretty much, that's insanely concerning, and we need to get the deficit down fast. So I'm gonna go through and make some estimates and see what we as investors need to be looking for in order to see a sustainable U.S. government over time that's not going to destroy itself with debt. So with that said, I made some estimates that will show what kind of deficits we need to be running in order to be sustainable fiscal path going forward. As of right now, the United States government is raising money via treasuries in order to pay interest on existing debt, which is completely unsustainable. So as I saw posted in that previous graph, the ideal range is probably going to be somewhere below 80% debt to GDP ratio. Obviously, lower is always better. But so here, I just made a calculation, and I found that roughly $500 billion per year deficit is kind of the maximum level where we want to be in order to get it down over time. And so I just calculated GDP out to 2050 using 2%, which is the Federal Reserve's target, and they're going to mess with all this stuff to make that happen pretty much, whether that be interest rates, QE, QT, whatever that is. And then I used that 500 billion a year to get the 2050 US debt. And then that gave me a debt to GDP ratio of 63 and a half for a $500 billion year deficit over 25 years and a 47.4% debt to GDP ratio if we were somehow run a zero deficit over the next 25 years, which basically is never going to happen, but a brother can dream. So, with that, we're going to go through and we're going to calculate how much interest the government is going to be paying and what percentage tax revenue. Because if we can get the debt to GDP ratio down, the GDP grows, which increases the tax base and will help keep net interest costs down for the United States government. But what we don't want to run into is a problem where we're spending half of US tax revenue is raising debt to pay debt. That's exactly what you don't want to happen. That's where it just gets spirals out of control and can collapse the government because they'll start to default after people won't buy treasuries anymore. So I applied those previous numbers, and so now we have I reused that GDP number of about 77 trillion, and then I calculated 16% was kind of an average from about 2014 until now as a the percentage GDP that's being taxed, about 16%. Honestly, it's likely to get a little higher over the next 25 years or so. But I'll stick with that, and that'll give us about 12.5 trillion tax revenue, and then we will go annual interest 5%. It's fairly likely that it gets lower than that, but just in case, I'll keep it up high. It's honestly pretty close to that now. Treasuries are trading about 4.5%. So I just went with 5% just to be conservative here. And that gave us a percent of taxes that go to interest at 19% for the $500 billion case and 14.8% for the zero deficit case, which is honestly pretty good. So that's going to tell us that 500 billion is going to be a sustainable number for us because that's going to let the GDP outrun the deficit, or sorry, outrun the debt because we just can't let these payments just strap. It's kind of like if you make $40,000 a year and then you get a $1,200 car payment. You're just completely strapped, and every single dollar you make is going to go to that. And you're not going to be able to invest in the country. Stuff's just going to start falling apart, and it's just not good and not what you want to see. It's kind of like my crap case scenario. If the people in Washington just continue to act like a bunch of bozos and just keep running up the debt as if it doesn't exist, you know, based upon estimates the Congressional Budget Office, Tax Foundation, I found that based upon our current path, they're expecting that we get to a U.S. debt of $120 trillion around 2050, which would put our annual interest payment at $6 trillion and 48% of tax revenue. So, I mean, we are quite literally on a path for catastrophe. So, as I mentioned before, as investors, we need to consider this as a long-term risk. And I mean, if this risk gets mitigated, good Lord, we'll have the best boom. It would be amazing. But like I said, keep that on your mind, guys. Like, this is a threat, and we need to pay attention and make sure that our government is not screwing us. I personally am going to remain long equities for the long term. I think the U.S. has a bright future ahead of us. I believe in our country, and I think that we're going to get this problem solved. But in the short term, we just need to look to make sure that this transformation of lower debt is happening, and we just really need to see that. Like I said, the trends of like AI, financial revolution, we have a lot of technological change underway, and I think there's massive opportunity for investors, and I will remain long for the long term unless this becomes an immediate risk. If you made it this far in the video, thank you so much for watching. I'd like you to like, comment, subscribe. If you like anything in the video or you'd like me to change anything for future videos to make them better, please, please, please let me know. I'd greatly appreciate it. And we'll be back in just a few days. Thank you so much for watching Systematic Investing. Have a good one.